50,000. Now, that is a massive milestone. Just on Thursday, the stock market was riding this incredible wave of sheer momentum. The Dow emphatically broke that 50,000 mark, and the S&P 500 cleared 7,500 for the very first time. If you were watching the screens on Thursday, it literally felt like this AI-fueled euphoria was simply unstoppable.
But then Friday happened. Contrast those champagne-popping highs with Friday's sudden sea of red. The Dow dropped 0.9%, shedding over 400 points. The S&P 500 and the Nasdaq, they both tumbled 0.7%. So the really crucial question here is, what exactly broke the momentum? How did we go from record-breaking highs to a widespread sell-off in literally 24 hours?
Well, welcome to this explainer. Today, we're going to demystify this incredibly chaotic trading day. We're peeking under the hood of those major index numbers to understand the actual underlying mechanics of this whiplash. Okay, let's dive right in.
To make sense of all these disjointed updates, we've broken this explainer down into 5 distinct buckets: the Friday market stumble, geopolitics and rates, a tech reality check, retail and small cap struggles, and finally, crypto moves and market quirks.
Let's kick things off with Section 1, the Friday market stumble.
To really grasp what went down, we have to look past those top-line numbers. Portfolio manager Jed Ellerbrook pointed out a really fascinating issue happening right under the surface. The broader market is actually lagging behind the largest tech companies. Earlier this year, we saw what was called the halo trade, where investors were pouring into sectors like consumer staples and materials. But recently, all that capital shifted heavily back into just a few giant tech names. And when only one thing is driving the market, it's inherently riskier. It makes the whole rally incredibly fragile.
You can see just how widespread the damage was on Friday. 10 out of the 11 S&P 500 sectors were bleeding. Materials and utilities took the absolute biggest hits, both down over 2%. Industrials fell 1.9%. And the only sector standing entirely alone in the green? Energy, which rose 1.6%. Honestly, when 10 out of 11 sectors fall, that tells us this isn't just a localized tech glitch. This is a broader market retreat.
Moving right along to Section 2, geopolitics, rates, and oil.
A massive focal point for the market this week was the highly anticipated summit between President Donald Trump and Chinese President Xi Jinping. Traders were watching this one incredibly closely, but the outcomes largely left them disappointed, mainly because there were no major policy breakthroughs. Now, they did agree to keep the Strait of Hormuz open, and China agreed to purchase U.S. oil. But the other headlines really underwhelmed. For instance, the agreement for China to buy 200 Boeing jets, well, that was only 50 more than what the company had already anticipated, which ended up sending Boeing shares down 3% on Friday.
Those summit headlines, paired with rising Middle East tensions, created a brutal squeeze on the market. WTI oil jumped to $104 a barrel, and Brent crude jumped to $108, which seriously revved up inflation fears. And how does the bond market react to that? Well, the 30-year Treasury yield spiked to 5.114%. That hits its highest level since May of last year. Higher yields are absolute kryptonite for high-growth stocks, which actually leads us perfectly into our next section.
Section 3, a tech reality check. So the AI fervor has been the absolute engine of this market, right? But those spiking interest rates we literally just talked about forced investors to take a really hard look at valuations. Adam Crisafulli from Vital Knowledge framed it perfectly. He said, "The group has witnessed an extremely unsustainable move in recent weeks and remains vulnerable to profit-taking regardless of the headlines." Think about it. When Treasury yields spike to 5.1%, locking in a risk-free return suddenly looks super appealing. That makes those high-flying tech stocks incredibly vulnerable to traders who are just looking to cash in their chips.
And cash in they did. Just look at the heavy hitters taking profit hits on Friday. Intel retreated 5%, Micron lost 4%, AMD dropped 3%, and even the giant, Nvidia, pulled back 2%. But there's always an exception. Microsoft actually jumped 4%. Why? Because billionaire hedge fund manager Bill Ackman revealed that Pershing Square built a new, massive position in Microsoft. He called it a compelling valuation after a recent pullback.
But perhaps absolutely nothing symbolizes the whiplash of the AI hype cycle better than Cerebras Systems. This chipmaker had its massive NASDAQ IPO on Thursday, surging an astonishing 68% and reaching a $95 billion market cap. And the very next day, it dropped 4%. It's the ultimate real-time example of traders aggressively buying into the hype and then immediately taking profits the second the macro winds shift.
On to Section 4, Retail and Small Cap Struggles.
Now, this anxiety isn't isolated to Silicon Valley. It's bleeding heavily into other corners of the economy. Take the retail sector. Investors are growing incredibly anxious about consumer discretionary spending right now, mostly thanks to sticky inflation. The SPDR S&P Retail ETF dropped more than 6% this week. That is its worst weekly performance since October 2025. We're seeing double-digit weekly drops in names like Kohl's, National Vision, and Sally Beauty. Meanwhile, larger players like Carvana and Amazon moved lower too, with major earnings from retail giants like Walmart, Target, and Home Depot just around the corner, and economic data showing retail sales growth slowing down to 0.7%, Wall Street is definitely very nervous about the health of the everyday U.S. consumer.
And that exact anxiety is hammering smaller companies too. The Russell 2000 tumbled over 2% midday on Friday. This is a big deal. It sets the index up for its worst day since November, snapping a massive 7-week winning streak. When small caps suffer like this, it clearly shows us that the pain of higher interest rates and inflation fears extends way beyond the tech giants. It's squeezing everyday businesses that rely heavily on borrowing to grow.
Finally, Section 5, Crypto Moves and Market Quirks. Let's look at how the most liquidity-sensitive assets handled the end of this chaotic week. Bitcoin is often heavily promoted as digital gold, right? A safe hedge against inflation. But on Friday, despite inflation fears rising, crypto tumbled right alongside equities. Coinbase fell 8%, Circle dropped 8%, Strategy lost 6%, and Bitcoin itself slipped back under that crucial $80,000 mark. What this tells us is that at least in the short term, crypto is trading exactly like a liquidity-sensitive risk asset. When treasury yields go up and liquidity gets tight, crypto gets sold off just like high-growth tech stocks. Yet right in the middle of that slump, we got a massive, fascinating bright spot. $100 million. That is the size of the strategic capital injection the Winklevoss Capital Fund just made into Gemini, the crypto exchange founded by Tyler and Cameron Winklevoss. The market absolutely loved this vote of confidence. Gemini's shares surged 22% in pre-market trading on the news. This was also combined with an earnings report that showed narrower than expected losses and a nice revenue beat. It just goes to show that even on a really down day, highly targeted capital can still ignite explosive moves.
And before we wrap things up, let's end this data dump with a fun human interest palate cleanser. $9 million. According to Reuters, that is exactly how much an anonymous bidder just paid in an eBay charity auction to eat dinner with Berkshire Hathaway's Warren Buffett and basketball superstar Steph Curry. The funds are all going to charity, and the winner gets to take 7 guests to Omaha this June. That is just an incredible quirk of the market to cap off an otherwise wild week.
Which brings us to our ultimate takeaway. We've seen the Dow cross 50,000 only to stumble a day later. We've seen 10 out of 11 sectors bleed as oil and treasury yields spike. We've watched traders ruthlessly take profits on AI darlings, all while consumer retail flashes warning signs. So I leave you with this to consider. With tech stalling and all these macro dominoes falling, is the great AI rally genuinely fragile, or is this simply a necessary breath before the next leg up? Keep your eyes closely on those treasury yields next week, and thank you so much for joining me for this explainer.